with Bajaj Finance, HDFC Limited is another company that has updated on its Q3FY21 operational performance. Well, the company's press release mentioned that the individual loan business has continued to see improvement. The disbursements in Q3 particularly grew by almost 26% on a year-on-year basis. And as far as 9 months FY21 is concerned, they were at 86% level of the corresponding period last year. So this definitely reflects that the disbursements are witnessing a very smart uptick. The housing finance major also added that they've assigned loans amounting to rupees 7,076 crore rupees during July to September period as compared to 4,258 crore in the previous year same quarter. All these loans were assigned to HDFC Bank as per their arrangement with the bank. Also, the loans sold in the last 12 months amounted to rupees 16,956 crore versus 21,066 crore in the last year. The company also updated that the gross income from the dividend stood at rupees 2 crore rupees versus 4 crore reported in the previous year. Also, the profit on sale of investments during this quarter was at about 157 crore rupees versus nil reported in the last year. Well, this profit on sale of investments was particularly on account of sale of nearly 25.5 lakh shares of HDFC Life, which is their insurance subsidiary. The company's shareholding in the company has now stands at about 49.9%, and the corporation has now met RBI's mandate of reducing their stake in HDFC Life to nearly 50% or below by December 16, 2020. So given that during this quarter we had profit on sale of investments and also gross income, the profit for this quarter would not be directly comparable to the corresponding quarter last year. Well, along with this, we have Motilal Oswal that has come up with a note on the entire Q3 update, adding that HDFC remains to be one of their preferred picks in the sector. Well, they add that they like HDFC's ability to gain profitable market share despite the competitive pressures. Additionally, contrary to the entire belief and initial expectation, the real estate sector has been improving and there has been a swift turnaround as far as the segment is concerned. Well, they also add that with incremental cost of funds from capital markets coming down and somewhere at about 5 or 5.5%, the company would be able to manage spreads despite the sharp cut in the home loan yields. In fact, they add that HDFC has built large provision buffers to keep it sustain, to help it sustain a spike in the NPAs in the upcoming quarters. So definitely a sharp or this sharp drop as far as the cost of funds is concerned, this will definitely be really positive as far as HDFC Limited is concerned, and they expect the company to deliver core return on equity of about 12 to 14% over the medium term.